identify it. The reason I'm starting out with this and just like a simple lesson on hammer candles and doji candles is quite frankly, this is a very high probability chart pattern with regular occurrences. And it's one that's not difficult at all to trade. First off, I'm going to go over here to the whiteboard. You guys should see the whiteboard application coming up. And this is really simple. In fact, it's about as simple as it gets. Why do you think the W pattern There we go. Because it looks like a W. Because it looks like a W. Now, there's two kinds of W's, aren't there? What? Two kinds of W's? Let's think about that for a second. Ah, Byron got it right. There's a capital one, and there's a lowercase one. You know, the difference in proper grammar and writing, I guess you'd say, I'm not no writing person. But with an upper W, the outsides are longer or higher than the hump in the middle, right? And with the lowercase one, they're right there about equal. Now, when we talk about trading a W pattern, you're going to find that just like with anything else, there's a textbook version written by those people that geniuses how to trade but probably never did it. And then there's the reality of what happens on the charts that we watch. Recognizable patterns are what you need to focus on, not so much of, well, you know, this kind of looks like it. If we were going with the textbook version, we would want to see charts that kind of look like this. Lower high that does not make a lower low, and in fact actually makes a double bottom. We'd want it perfect. You know, if it bottomed out at $100, we would want this side to be $100 too. But that's not how it happens. The way to trade that textbook way is really based more on your personal preference. At this area, how would I do that? At this area of the W, you have a double bottom, but you don't have a W pattern. There's a double bottom play where the would become your stop. These are not always momentum type plays. Sometimes they can consolidate and go sideways right around your little line. For quite some time. Typically what you find is that the momentum comes center of the W. Well, a lot of times with options, momentum play is actually better. Why would momentum play be better as an options trade than maybe focusing on the bottoms? Where your premiums move faster. Usually while you're making that bottom, you kind of make it a couple times, don't you? Or you might go sideways across it. So time decay can get you. That theta monster will get you pretty good. You know, typically when you get the breakout move, you've got higher volume coming into the stock. You still have theta on those as well. Doesn't matter if you're in the money, out of money. Theta will affect it in some way. And let's face it, most people don't want to wait on a trade to develop. I do. I like getting in down here. I like getting in down off the bottoms, knowing that it could take time for, you know, for that to take care of itself. As far as that goes, if you want the momentum play, on the break of the center of the W is where you'd play it. Like any breakout type play, like an ascending triangle, any of the wedge patterns, cup and handle, you name it. Where would your stop be on a momentum play, a breakout play? Where would you look at? Yeah, the breakout line, right? So if you went up from where you broke out, that's great. But you should never be in that trade as it goes up and comes down below this line. If it comes down below that line, that trade is over. Well, the breakout would mean it actually breaking something, which would be the top line. The bottom line just is marking the double bottom. Now the other way, one could look at trading with the W pattern. It's the way that I kind of like to do it. Is once you've recognized that double bottom area, I like to look at taking a small entry, usually typically about 1/3 of a position, knowing that it's going to be a little bit slower, knowing that my stop is pretty well defined. And as that right side of the W starts to unfold and make its break above the breakout line, I'll usually put in the other 2/3 of the position. What that does for me, there's actually two things that does for me. Any ideas? You guys are exactly right. See, if I stop out I have to stop out on a first entry with only a third of a position in it, maybe it fails that bottom line, then anything I lose is going to be lost on only a 1/3 position. What that means is if I took a 10% loss, it'd feel like a 3.5% loss. If I took a 30% loss, it would really only have the effect on my account of a 10% loss. Heck, if I took a 100% loss, the effect would be seen on my account as only being a 33.33333% loss. By the time I come up to here and make the 2/3 buy, because I've got the buy in at the lower price, my average is lower because of the first buy. And so long as I trade the pattern correctly, if I stop out of the trade, I don't lose any money, right? Does that make sense to everybody? Okie dokie. So what I want to do is I want to identify W patterns on a chart. We're going to start out with a weekly chart. And as we kind of watch things unfold on this weekly chart, you're going to start to see something here. Now you notice how at this point that this is holding up to what you could say is visibly, maybe not by price, but visibly a double bottom, right? And we're going to talk about common shares only because you can relate option strategies to common share strategies. But as we start to hold up here, and this is, you know, the summer of 2012, and to make numbers easy, let's assume that by the close of this week, because it's a weekly chart, at $97.43, that I decided it had held this line long enough that I would be willing to buy for the potential at a W. But knowing right now it's only a double bottom. To make the numbers nice and easy, if I were to have a $90,000 position size, how much of it would I use to buy right now? There you go, 30,000. And to make math really, really easy, we're paying $100 a share. So if I took $30,000, divided it by 100, I'd grab me 300 shares at $100. Where would my stop out be? A close below the lowest close, right? Which is $88.75. Now, because I round up on the $100 share price, I'm going to round up to 90 bucks. If I paid $100, it stopped out at $90 a share, what is my loss percentage? 10%. Good job. But what would the effect seen on my account be if I'm playing consistently on my position sizes, but only made a 1/3 entry. What loss would I see if I stopped out of this trade? About a 3% loss based on what a full position size would have been. Now, there's an easy way to play devil's advocate with this type of trading strategy on this chart pattern. One could very easily say, but if you wait to buy, you're going to make less money. And if you buy, you could lose more money. And then we can agree on that. Now, as time goes on and things move forward, you notice it's usually quite a bit slow to really get moving. Oh, there's a little bit of action. Now, also, we need to note is be on the highest close. You know, at this point right here, it almost looks like it was just a double bottom play that may have gone to a double top and pulling back from it, right? This is the space, and that what you presume will become the is not 40%. In many cases, you're lucky to see like 8, 12%. So at that point in time, you do have risk potential greater than a target, because your target would be that prior high. If it breaks, that you would look at another buy. Now, if my total positions is $90,000 and we only put a third of that in, how much money do I have left to buy Goldman Sachs shares with? $60,000. To make math easy, we're going to go at 461 shares. Now, I always trade this pattern with a candle on the W break. Why can I get away with trading it with a confirmation candle? Meaning, if it came and closed just barely below the line, I would give it the next candle to see what it does. Why can I get away with doing that? Yeah, because my average right now, if I bought 300 shares at $100 at 130, and if we added those together and divided it, sorry, took $90,000 and divided it by 761, my average is $118. So if my $130 turns into $126, right? Or $125. Now, where would I make the decision to not wait for the confirmation candle, like a candle that closes below, and not give it the other candle? Well, that's what your news feeds are for, knowing when the earnings are and stuff like that on your stocks, because those could have an impact, and if you get a fundamental change, you may not want to wait to see if it comes back. As time progresses here, we come right back and we close just barely below the line. This is where I personally would use that confirmation candle. Oh, good. I'm not sweating. But let's say you did get in right here on the W. Things progress, I'm left with a decision to make here. What does this look like to you? Yeah, I mean, it looks like it hit my target and pulled back, right? And on my average, I'm up $45 a share, $44 a share. I'm sitting pretty good. Just like on my stops, trading it in this way, I'll give it that confirmation candle. When this candle opens and pulls back below the close from the prior candle, this is where I'm going to start selling. Now, how much of it do you think I'm going to sell here? Well, I've always used a different mathematical equation for my buys and sells. I like to buy in thirds and sell in halves. So if I have 761 shares and I divide that by 2, I can't sell a half a share, so I'll sell 381 shares. So I have 380 left. Like I said, this next week, it gaps up and it starts moving upwards. It was a green candle at some point. And I'm then entering my physical stop at the close from the prior week. So 162.92. So I take my 381 shares, I make a little money off of it. Where's my stop on the remainder of my shares? I already moved my stop up from that. I had gotten a higher low, and I just got a higher high that validated that higher low. Why would I give that up? Did I just get a higher close than my prior high close? Absolutely. So I move up my stop. As the trade continues on, oh, well, now I'm pulling back again. That one got close, didn't it? Now I've got a new stop. You see, I'm quick to take profits on parts of my positions. I am quick to do that. But on a good chunk of my shares, so long as it still obeys some simple rules, why sell a winning trade? Continue to move upward. And anytime it closes with a higher high, or in this case, what happened here? Yep. So here on November 30th of 2013, I would hold the remaining 380 shares with a stop order at this close at 156.55. So 156.55 times 380 gives me 59,489 bucks. Now, if I add to that the 60,007,252 I already took, take out my 90 grand, I didn't do too shabby, right? To answer your question, Josh, I got with 2/3, broke the W. As we go through this series, it's literally going to be like a 6 to 8 weeks long series. You'll find that I use these chart patterns to dictate how much of, like how many thirds I buy with, because it's based on their probability type thing. As you go on and continue here, that my stop out wasn't a bad idea. Even though it immediately went back up, it didn't go up much. I'm making lower highs and lower lows. Now, in the event that I would not have sold on a pullback from my target here, I would have sold half on the first lower low, would have been here. At the end of this candle right here. The point with trading, though, is you are so rarely going to catch a low and so rarely going to catch a high that you cannot focus on that. You need to find things that you can implement consistency on and trade it. And as you see with your W pattern, we got a consistent trade based off of a pattern, and it was easy to follow along with.